Live from Singapore, this is Insight with Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Cautious optimism on Asian markets with expectations running high for the U.S.-China trade talks this weekend. Bloomberg can reveal that the U.S. side may offer a significant tariff reduction as a first step. We'll be taking the market temperature on trade with DWS, hear why their APEC CIO Ivy Ng thinks peak tariff fear has passed. Also ahead, India says it neutralized Pakistani drone and missile attacks targeting military sites, marking an escalation in hostilities between the nuclear-armed neighbors. Get insights on how the conflict could play out with Associate Professor of Political Science, Mariam Mufti from the University of Waterloo. Plus, why investors worried about geopolitical turmoil may find safety in securitized credit markets. We discuss that with Schroders Capital Head of Private Debt, Russell-Dowe. Our top story today, expectations are growing for the first high-level trade talks between the U.S. and China since President Trum unleashed his tariff barrage. Treasury Secretary Scott Bessent and Trade Representative Jamieson Greer are due to meet this weekend in Switzerland with Chinese Vice Premier He Lifeng, and Bloomberg has learned that the U.S. side has set a target of reducing tariffs below 60%. As a first step, they feel China may be prepared to match. Also high on the U.S. wish list is securing the removal of China's export restrictions on rare earths. President Trump says he's optimistic about the discussions.
Well, it could be. I mean, we're going to see. Right now, you can't get any higher. It's at 145, so we know it's coming down. I think we're going to have a very good relationship.
Well, earlier, Trump pitched his trade framework with the UK as a historic achievement, even as it fell short of the full and comprehensive agreement he had promised. Prime Minister Keir Starmer concedes that the two sides still need to finish ironing out details, but nonetheless hailed the deal as fantastic.
I believe that serious, pragmatic, in-the-room negotiations acting in the national interest are far better than performative politics, people slamming the door, floundering out, being performative but not actually delivering for working people. And I'll continue in the same vein. We've had two trade deals this week by acting in that way.
As we talk about the upcoming trade talks, we're also keeping an eye on those Chinese export numbers for April. It's just breaking right now. China's January-April exports climbing 7.5%. That's year-on-year in yuan terms, and that's according to CCTV. We're seeing in terms of China-April imports in yuan terms rising 0.8% year-on-year, and that China-April trade surplus coming in at 0.7 trillion Chinese yuan. Of course, those China's April trade report in focus. Expectations are that tariffs will slow but not crush exports in April. Bring you the USD terms as they come in. Meantime, China April imports in yuan terms rising 0.8% year-on-year. In terms of the Chinese yuan, the reaction currently pretty flat versus the USD 724.56 is the number we're looking at. In terms of that trade surplus, of course, 0.7 trillion yuan is that number we're looking at for the month of April. Now, let's take more on trade talks with Bloomberg senior editor Derek Wallbank. Derek, what more do we know about the Trump administration's plan for a potentially dramatic tariff reduction? That's what they've been promising. That's what we're saying currently.
Well, Haslinda, the word of the weekend is de-escalation, right? The White House has said that's what they're looking to do in these talks with Chinese officials in Switzerland, de-escalation. This is not something that you should read as we're going to go and get a full-throated agreement. This is not even something that you should read as maybe we're going to get a framework for an agreement. Instead, the idea is take the temperature down. There is, as you quite rightly noted, are reporting that suggests that the Trump administration would, in an ideal world, like to be able to pull tariffs down below the 60% level. That would put them kind of in the ballpark of where they were on the Liberation Day announcement before there was the re-escalations beyond that after President Trump retaliated to Chinese retaliation to his own tariffs. So that's kind of what de-escalation might look like. I think we'd heard the term, but if you're talking about what does that actually look like in principle, maybe that's something there. The other thing is that Scott Bessent has said in recent days and weeks, the idea here is to kind of set the table for future talks. If all of that sounds very preliminary, that's about right. It should sound preliminary. This is not in any way final, but it is really about that sort of table setting for future things. You know, Trump said that the 145 and 125 on the Chinese side levels are basically an effective embargo. It really has sort of hampered trade. We've seen companies try to front run supplies to get to sort of cushion a blow and prevent being charged at that full level right now. And there is more pain to come. So trying to get down off of that, I think, is the imperative.
Derek, you got to wonder how China might read into that perhaps dialing back of tariffs to 60%. Is that good enough for China to take talks seriously? Of course, on the back of that disappointment we saw in terms of that talks within the US and the UK, it wasn't as big a deal as it was touted to be initially.
Well, Haslinda, you know, I am maybe on my own island here, and that's okay. But I sort of read the US-UK thing as a little bit of like, yes, on the subject and the details, and you know how I love swimming in the weeds of details. Yes, on that you can read it as it's a framework and it's underwhelming. But you and I have talked for a long time on this show before about how the very first thing to come was going to be a framework, right? And one of the things that you can say that's the inverse of that is, wait, this is what it takes to de-escalate. And if you're sitting there talking about, you know, again, this is all cart before the horse, but if you were to be in a world where after these talks at the weekend you got down into the 60s of that, and that was just simply two great powers looking to ease the burden themselves, those two things get pulled off, maybe you get some easing on rare earths or something. That's, again, a very small concession on both sides that winds up having a very large effect, right, of essentially cutting that tariff burden in half. Now, if you're sitting there talking from a current policy baseline as of March, when none of this stuff really existed, or January or something like that, when this was just, you know, this wasn't on the table, okay, that's a different state. You sit there at that point, you say, look where we are in the world 5 months later or whatever. Okay, yeah, no, I buy that. But where were we on April 2nd? Right?
Derek,
So if you're
Derek, let me stop you there. I'd just like to talk about the trade numbers coming in for China in terms of USD terms. China April exports in USD terms rising 8.1% year on year. The estimate was for 2%. Its April imports in USD terms falling 0.2% year on year. The estimate was a minus 6%. So it does seem like in terms of trade numbers, they have come in stronger than anticipated in April. We've yet to see that massive impact from those tariffs. Now, Derek, let's bring you back into the conversation. It's not just China having those talks with the U.S., the likes of Japan, Korea, India. They're also hoping for a positive outcome. We heard from U.S. Commerce Secretary Howard Lutnick, giving some indication on how he thinks those talks will take place. Take a listen to what he had to say.
But obviously, when you talk about Japan, I mean, come on, you've got to spend an enormous amount of time with Japan, Korea. These are not going to be fast deals. Now, India's been leaning in really hard, right? You know, I love doing a deal with India. That's certainly a possibility. But this is a lot of work. These are a lot of lines.
Could be tougher than they think, Derek.
Well, certainly tougher than the UK, right? You know, the UK, the trade deficit is a very different story to where it is with India or some of those other places that you mentioned. You know, and I would put some more into that discussion besides about where some of these talks might be going. But yeah, look, Japan's going to be harder, India's going to be harder still, but again, we're looking at where the, you know, what's going to be necessary to get those things over the line. We've already seen some concessions on the India front, you know, and so you've seen movement in that kind of positive direction. Yes, Lutnick is sitting there saying that this is going to be, this is not going to be necessarily the easiest thing in the world, but he's also still sort of signposting that we're in positive direction in that sort of thing. You know, the thing I think a lot of markets have been concerned about, Haslinda, is that we're in this like Wile E. Coyote formation of we're off the cliff and we don't know that we're going to fall, and the idea of pulling a de-escalation on many fronts before that fall takes place, I think that's the urgency, and you're seeing positive sentiment on that this morning.
Derek, thank you so much for that. Bloomberg Senior Editor Derek Wallbank. Just to recap some of the headlines we're seeing in terms of those trade figures out of China. China April exports in USD terms rising 8.1% year-on-year, beating the estimate of 2%. We have the trade surplus. Remember, this is an issue with the U.S. It's April trade surplus coming in at 96.1 billion. The estimate was 93, so the U.S. wouldn't be happy with that trade numbers. Bearing in mind, though, the drop in terms of trade may have happened at the tail end of April. We may not see the impact just yet in the numbers that we're seeing for April today. Well, let's talk trade, let's talk the impact, let's talk markets. Joining us now, Ivy Ng, APAC Chief Investment Officer at DWS. Ivy, good to have you with us.
Good to be back.
You know, the trade numbers speak for themselves. China, in terms of trade, isn't slowing as much as anticipated. That's not quite surprising because it's usually the tail end of April. We'll see the impact slightly later. Is that a fair way of looking at it?
Yes, yes. If you look at the data itself, actually it's more like the last 15 days we did see like the slowdown, but before the first half of the April is still like a quite strong number. And I'm sure there are a lot of countries thinking about building up the inventory first. So it's not surprising to see like the export number actually picking up from China.
How does that change shape your appetite for investing in China on the back of the moves we saw from the PBOC recently, you know, suggesting that it is prepared to lift the economy?
I would say like for our investment in China hasn't really changed that much because like all along we have been like taking a more barbell kind of portfolio strategies. On one hand, we like the defensive high dividend yield stock. That's where we think that relatively stable. It's more like domestic market focus, not export driven. But on the other hand, we also like those like consumer facing technologies names that which can continue to deliver strong earning growth, and then like in terms of the margin improvement and also all these like capital management initiative they're taking, we are still positive of that. So in the portfolio itself, we are actually quite balanced.
So would the outcome of the talks between the U.S. and China this weekend change your opinion in any way? We're already suggesting that perhaps we could see a massive dial back in terms of tariffs down to 60% from 145. Would that change the picture for China?
I would say that it's definitely like it's a good sign for the de-escalation. So like in terms of the like fear on the sentiments, it's probably we have seen the peak. But I still think that like the tariff impact like right now is not on the magnitude, it's on the durations. So how long is like all these like tariff impacts going to be on the market? It's going to be a relatively long time. And the business impact, we haven't really seen it like so far. So far, you talk to the company, yes, so most of the time we're saying that, oh, we're holding on all the expansion plan. But have anyone immediately like find people, immediately returning the space that they lease up? We haven't seen that way. So those business impact we're going to see in the next few months' time. So in terms of the strategy part, I wouldn't say that we will have a big change, like in terms of what I just say, like one side more defensive, the other side like target of the growth part. But like I would be quite concerned if people are too optimistic about like the trade talk in the future, because we're thinking about there's no point we go back to the level that pre-Liberation Day.
So de-escalation expectations are pretty much priced in already So there's a higher side or higher chance of disappointment in the market than otherwise, you think?
I do agree with that view, because if you look at the deal between like UK and US last night, so basically the reciprocal tariff, the 10% is still there. And then like, yes, it shows that there's room for the sector negotiations, but then for this sector tariff part, like it's really, I think, depend on the situation by each of the country, because the UK export of car to US is actually not that high. It's basically only 2% of the market. But then like for Japan is another story. So can Japan get the exact treatments like UK is questionable. We'll be looking forward to see. And also like the overall story I got, like it's more about still like US increase the trade barrier versus like UK actually lower the trade barrier. This is a situation I see here. Will other countries follow? Can other countries also like EU and China be like they lower the trade barrier with US but let US increase the trade barrier? I do think like the talk with other countries will be relatively difficult. So if people assume that first we see the first deal between like US and UK, we will see the same deal across all the other countries, that may be like too optimistic.
There are two themes in the market: sell the dollar and also pull back from US exceptionalism. How is that shaping where you're putting your money?
I would say like, yes, in terms of the currency, we do think like yen and Europe will be having more upside than the dollar part, definitely. But in terms of like the asset price or like positioning, one of the cities is actually quite interesting. Recently, like Hong Kong has been like back to the discussion. We have seen the Hong Kong market actually doing relatively well. The good thing is like we have seen like HIBOR has been like going down significantly. And Hong Kong market used to be like running on two drivers, like lower US like financing costs and then like a strong China growth, right? Of course, these two drivers were gone over the last few years. And now with the side that like with a wage cut potentially coming in the next like 12 months, we definitely see wage cut coming. So HIBOR also going down. And China economy is stabilizing a bit. So that would be actually bode pretty well for like China, for Hong Kong asset class.
The thing is, you're quite upbeat when it comes to the Hong Kong property sector. Why is it so underappreciated? There are risks out there. There is a reason why people are still waiting on their hands, not buying into the Hong Kong property sector.
Yes, definitely. If I look at all the data, I can definitely share the same cautious view with like
occupancy rate.
Yes, the vacancy rate is still at historical high. And then our rent growth is still on the negative trend. Quarter over quarter is still negative. Like be it office, be it retail, continue to be tough. You have to think about the overall picture is like for the Hong Kong retail, like historical 30% of our Hong Kong retail sale depend on the Chinese tourists. So those are still a big contribution for the like Hong Kong retail market. Of course, like Chinese spending changing, Hong Kong people's spending changing, those will be having an impact on it. Same for office, like before the COVID, if you talk with the major landlord in the core CBD area, like 50% of the leasing demand, new demand actually from like a Chinese corporate way. So it's easy to understand why people are still cautious about the overall Hong Kong market itself. But recently we did see some like a positive sign. It takes some time for the vacancy to get absorbed or the rent to picking up. But like we did see some like strong transaction number coming out from one of the major like central landlord. So that was a supportive on the capital value side. And I think like with the HIBOR going down, the mortgage rate people are paying versus the rental yield is getting to be a more favorable like story right now compared with the past. So potentially we can see the demand picking up. And the key part is that with US dollar weakening and the Hong Kong dollar weakening, you will see that like basically potentially more Chinese, hopefully tourists coming back to Hong Kong.
Even as we talk about weakening of the US dollar and hence the Hong Kong dollar, we're seeing the USD actually climbing the last 3 days. It is currently at the highest level in a month. Could you be overestimating the weakness in the currency?
I think it depends what you have priced in. I think in the beginning of the year, given the trade like trade tariff discussion on the market, a lot of currency strategies has been expecting like weak renminbi. So weak renminbi generally is very bad for the like Hong Kong retail market. So right now, yes, you see like a couple of days picking up on the US dollar. But in the long term or medium term trend, like basically most people agree that the US dollar is more on the like weaker side. Not saying about renminbi will be appreciated in a big way, but it's just like the depreciation magnitude probably is not as high as people expected. And like the best scenario is like currency volatility is stable. Of course, we need to see like what will be the end result of the tariff talk.
That's right. We wait and see.
Yeah.
We'll see soon enough since it is this weekend. I'm just wondering, apart from Hong Kong, you're also liking Japan. Talk to
Yes.
us about the opportunities you see there.
Yes, so Japan is actually a very interesting market. Of course, we like the capital management initiative we have been seeing like all these Japanese companies doing, so that's the positive side. But for the Japan real estate, is also the market that we are very positive about. One of the concerns people will have for the Japan real estate market is the interest rate hike. In the beginning of the year, there are lots of debate, like some people putting in like 3-4 times of rate hike expectation in Japan market. But with the tariff discussion going on, like uncertainty of the economies, right now the rate hike expectation has been turned into like I think next 12 months, and most people putting kind of one rate hike expectations. So with the rate hike expectation kind of tempered down, you can see that it's actually bode pretty well for the real estate stock. And that's one point. The second point is more about like with the current Japan situation, they're actually running a very tight labor supply. So a lot of constructions has to be like delayed. So the demand and supply story has been very favorable for the real estate sector. For give you an example, for the Japan logistics sector, like people in the past was also kind of worried about, oh, the supply will be picking up. Same for the office sector. But these two elements, like in terms of the supply, we see that it has been moderating down because it's just like not enough like construction worker to work on all these projects.
The thing is, Ivy, they say Japan is also the land of the rising dissension. We're seeing a surge in activist investors.
Yes.
Is that a risk?
Is that risk? No, it's a potential for us because we do see the more the activists participate in the company is actually pushing them to improve their capital management initiative, selling down their long-core asset, thinking about how to unlock the value. So more activism in the Japan company is actually more positive.
All right, Ivy, we have to live with that. Thank you so much for joining us today.
Thank you.
And helping us in dissecting all the issues of the day. Ivy Ng, Chief Investment Officer, APAC at DWS. Now, still ahead this hour, India and Pakistan accusing each other of drone attacks. We get analysis with the University of Waterloo on the potential path to de-escalation. Keep it here with us. This is Bloomberg. We're casting our eyes on the U.S.-China trade talks over the weekend in Switzerland. A lot is at stake. Meantime, we're also keeping track on the trade data out of China for the month of April. China's export growth rising even as shipments to the U.S. slumped in the first month after President Donald Trump hit its goods with tariffs above 100%, a boost for a domestic economy that's been increasingly reliant on foreign trade. In terms of numbers, total exports expanded 8.1% last month. That's above the 2% increase forecast by economists. In terms of shipments to the U.S., they fell 21% after those tariffs in early April. Imports falling 0.2%, leaving a trade surplus of $96 billion. Now, what we're seeing in terms of the data today is that perhaps a sharp drop in shipments happened in the final days of the month, so perhaps pointing to worse days ahead for May and June, where perhaps we'll see the impact in a bigger fashion. The CSI 300 currently down by 0.2% in what is a positive day for Asian markets. The Hang Seng also lower. In terms of the currency, we have the yuan trading at 724.84. It is down about 0.1% versus the USD. And we're doing a check on other Asian currencies as talks are underway between the U.S. as well as Asian trading partners. The yen at 145.63. Well, still to come, India and Pakistan continue to trade blame and accusations. We delve deeper. This is Bloomberg. The latest on the situation, India and Pakistan say they've shot down drones and missiles over densely populated areas in a second day of military hostilities. Pakistan's army says it took out several Indian drones over cities including Lahore, Rawalpindi and outside Karachi. India says it neutralized Pakistani drone and missile attacks on Wednesday and Thursday, targeting military sites. No casualties were reported by either side. Now let's get insights from Mariam Mufti. She's an associate professor in the Department of Political Science at the University of Waterloo in Ontario. Professor, good to have you with us. Obviously, an obvious escalation in the conflict between the two countries. Put this into perspective. How concerned are you, especially in comparison to what we've seen before in 2016, 2019, even though the circumstances are quite different?
Yeah, so the circumstances of this particular conflict are certainly quite different. Number one, the way India has reacted to this particular incident in Pahalgam is unprecedented. India has never before suspended an international water treaty with Pakistan. India has also never targeted the Pakistani heartland, and particularly the province of Punjab since 1972, since the ceasefire agreement between the two countries. So certainly the way this conflict has escalated is quite different from what we've seen before, and that gives many analysts pause, because these are, of course, nuclear-armed states. These are countries that have domestic political constituencies that will not be satisfied without action. And we have constituencies on both sides and leaders that are leading hyper-nationalist foreign policies.
So at this stage, it's hard to see a de-escalation, but might there be an off-ramp? Might there be an opportunity for that de-escalation?
Perhaps there is an opportunity, right? So India claims that it has carried out strikes, very precise, well-thought-out strikes on 9 terrorist infrastructure sites in Pakistan, and that this was a calculated move by the Indian military. The Pakistani military is, of course, claiming that, well, they have downed Indian fighter jets, including the superior Rafale fighter jet. It is also claiming to have shot down several Indian drones. So is it possible for the Pakistani government to claim that the losses that it has inflicted on India is enough of a response to what India did just 2 nights ago? This presents a situation where a possible off-ramp could occur for both sides. Both sides could claim victory of a kind and cool the temperatures.
You know, we talk about that Indus water treaty that was suspended. Give us a sense of how significant that is, because I think a key takeaway is that Pakistan's ego was dented in the process.
Absolutely. So in 1960, a water treaty was signed between India and Pakistan that shares the waters of the river Indus, the headwaters of which are in this disputed territory of Kashmir. This river is a lifeline for Pakistan and absolutely critical for Pakistan's 250 million strong population. It is used for Pakistan's agrarian economy, it is used for industry, it is used for sustenance. Without this water, Pakistan really cannot survive. Now, India is upstream, and by virtue of being upstream, India can dam up these waters and divert them towards northern India and deprive Pakistan of its principal water source. Further downstream, this river has 5 tributaries that are also, the waters of which are also shared between India and Pakistan. In 1960, this treaty that was brokered using technocratic expertise without securitizing the issue of water is a treaty that has lasted several decades, despite the fact that peace talks between India and Pakistan have continued to fail. So this is a very, very critical treaty. Now, in 2024, India did signal to Pakistan that it would like to renegotiate and renew the terms of this treaty, citing demographic needs and changing demographic needs. So the suspension of this water treaty is quite the reaction from the Indian government, but perhaps it was one that it was pondering since last year.
Earlier, you talked about how it is a big concern given that both sides are nuclear powers. On a scale of 1 to 10, how would you assess or rate the risk of perhaps Pakistan resorting to strategic weapons in this conflict?
I mean, I don't think that at this point that is what the Pakistani military is contemplating. It might be contemplating another response beyond what it has already done, which is the downing of the Indian fighter jets and drones. However, I mean, if Pakistan were to escalate this conflict, we have to bear in mind that Pakistan also does not possess the same amount of strategic depth that India has. And if this conflict were to escalate, and if this conflict were to prolong, India is more likely to prevail because it does certainly rank higher on the global firepower scale than Pakistan does. So even if Pakistan were to take the first strike, I mean, nuclear weapons really are a deterrent in South Asia, given how close these two countries are to one another.
Is there any signal, suggestions, perhaps both sides are getting diplomatic support, and if so, from which countries?
Right. So there has been reporting that the NSAs, the National Security Advisors on both sides, have met, that there have been some back channels that have opened up for diplomacy. And this is, in fact, a very, very good sign. As far as the international community is concerned, it remains to be seen. I mean, the statements that are being made by international players, particularly Western countries, do not necessarily seem to suggest that they are working very hard on de-escalating this conflict. Of course, they have all made statements to say that India has the right to self-defense. They've all made statements that terrorist activities cannot be tolerated. They've all made statements that both countries, nuclear-armed, should de-escalate the conflict because the world cannot afford another such conflict. However, have they done anything concrete in order to de-escalate the tensions? We haven't quite seen that. And it appears to be that the international community lacks the appetite to mediate between India and Pakistan, given how it's bogged down with so many other conflicts right now.
Right, and you got to wonder, Anna says, China's role in this conflict. Of course, we've talked about possibly Chinese weapons being used on the battlefield. I mean, do you see China playing a much bigger role in this conflict to the conflicts we've seen before between the two sides?
Yeah, typically we haven't seen China intervene in a conflict between India and Pakistan in quite as direct a way as it has at this time. China did come out with a statement saying that it very strongly believes in Pakistan's territorial sovereignty and that it will not tolerate a threat to Pakistan's territorial sovereignty. What is also different now is that Pakistan is home to Gwadar port that has been built using Chinese loans, and Pakistan plays a very, very important role in the China-Pakistan Economic Corridor and China's Belt Road Initiative. So China definitely has a stake in this particular conflict. I mean, also bear in mind that China and India have a disputed border as well, very close to Kashmir, and then the rest of the border, which is also contested between the two countries.
Right.
Yes, Chinese weapons are being used in this particular conflict because China is Pakistan's all-weather ally, and in fact, 80% of Pakistan's arsenal is now China-made and China-sourced, as opposed to India's, which is a little bit more diversified than China's. But India is relying very heavily on U.S. backing and Russia-made weapons. So, so maybe what we are also seeing over here is a competition between these two different military technologies.
High stakes for China, high stakes too for the U.S., except that we've yet to hear the U.S. say it will back India in this conflict. The most we've seen is what we heard from President Trump, who said that it is a shame, but that has been the extent of that response.
That's right. I mean, President Donald Trump has not come out making any strong or powerful statements in support of India. I think part of what's happening right now with the United States is that they lack any kind of diplomatic way into this conflict because there are no envoys yet appointed to South Asia, neither Pakistan nor India. The United States also is lacking a South Asia foreign policy and a South Asia strategy ever since it's pulled its forces out of Afghanistan. And I think America has been caught on its back foot. Furthermore, I think the first 100 days of Donald Trump's presidency have actually hurt the United States' position globally, given what it's doing to the economy right now. And yet, we know that for the United States, India is actually the much more important partner in its quest to contain China.
Right. Professor, thank you so much for joining us on Inside. Mariam Mufti, Associate Professor at the University of Waterloo. We're counting down to the Open in India. It will start trading in about 4 minutes from now. Of course, we're expecting a pretty much volatile session on the back of India saying it neutralized Pakistani drone and missile attacks targeting several military sites on Thursday night. Of course, the attacks were part of an escalation in hostilities. Pre-market session in the negative, Sensex down about 1.7%. We have Nifty futures trading up by about 0.4%. We're also tracking the Indian rupee currently flat versus the USD. By the way, recent appreciation versus the dollar has supported the recovery in local shares, but that is unlikely to sustain strength over the long period of time. We're also watching for the start of trade in Pakistan stock markets in the next hour. The benchmark KSE 30 index extended losses yesterday, plunging more than 7% for its biggest sell-off in about 5 years. The Pakistani rupee also weakening there as we speak. Now, coming up, Schroders Capital joining us to talk about the importance of securitized credit markets during times of volatility. Plenty more to come. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. The booming $1.6 trillion private credit industry may be poised for more growth as it increasingly branches out to higher quality borrowers. That's according to a new report from Barclays, which estimates a potential market size of $22 trillion, tallied across public credit and commercial bank balance sheets. Barclays says capturing even a small part of that growth could lead to hundreds of billions of dollars in deployment opportunities in the next 10 years. Well, joining us now is Michelle Russell-Dowe, co-head of private debt and credit alternatives at Schroders Capital. Good to have you with us.
Thank you so much for having me.
We talk about the great potential, but I'm just wondering whether the credit market is actually being put to the test because of the uncertainty arising from the tariffs.
I absolutely think that's the case, although what exactly is that test? I've been doing this for 30 years and I've definitely seen worse.
And how's the market reacting and where is it heading on the back of that?
So interestingly, if you look across both the liquid and private markets, even though it feels bad, I think it's only because we're used to a pretty nice market, right? And so from my perspective, as you look across the landscape, we've had a test, but not the test, right? We've had an opportunity, but not the opportunity. Spreads or risk compensation is wider, but it's not wide. And that's what I mean. There's been much more significant credit tests in the market. And actually, if you look at this and you look at how markets have reacted even to the news yesterday, everybody feels quite a lot better fairly quickly, right?
But this is a market that continues to want to feel good.
Yes.
It takes very little to convince markets to go higher.
Indeed.
But I just want to take you back to Liberation Day when everything changed, right? We saw how treasuries got dumped along with all the other asset classes. Has that fundamentally changed the psyche of investors, and how is it playing out in the credit space?
You know, interestingly, I think as I answer that question, if you look at the impact on currencies, we see some really different things going on, and that is one of the elements that I think has maybe fundamentally changed what we're dealing with in the credit space, right? The credit space is going to be very sensitive to supply. It's actually one of the reasons why the private credit market is so interesting, because it becomes a place where you can go with supply if the public or syndicated markets where we see that distress and where we see that selling going on, right? So the private credit market development may have provided some insulation to how bad things can get. or it may have really convinced people that things can't get that bad that quickly. So as I kind of look at this landscape and the fundamental changes in currency relationships, that's going to change the buyer base for securities. And that's one of the reasons why the private credit market may become more important, but it's also one of the reasons why I think we're going to be dealing with uncertainty and volatility for longer. People aren't used to changes in some of these fundamental relationships. And when you see those changes, that represents a structural change in the market, and we can expect to see things work a little bit differently than maybe what we're used to.
So, following up on what you've just said, where do you see the opportunities?
Well, I mean, we all live with our own biases, right? So I'm going to tell you I see the opportunities where my home base sits, right? And so we have a pretty unique home base at Schroders in terms of what I cover, which is I cover debt, but I cover debt that's generally secured, both on what I will call the liquid or syndicated market side. So that usually comes in all kinds of acronyms, right? That's where you hear the ABS and the CLOs and the CMBS and the MBS. But all of those individual transactions, if they're not syndicated, might also be seen in the private markets. So there's a nice continuum, if you will, in terms of what we cover. So when I look at that space, which is really my home base and expertise, where I see the interesting opportunities over the course of the last couple weeks is where there has been supply and where there has been selling. And actually, if you look at the difference between the corporate credit markets and these securitized credit markets, you actually can see more persistency of supply. So for me, that's in markets like CLOs or MBS on the public side, where there has been more selling. So it's almost as if you see better opportunities where the market has a greater sensitivity to that supply coming out. So MBS, all these acronyms, and CLOs have been the more interesting opportunity for us over the last couple of weeks. But should that opportunity come back, be more acute or more prolonged, we would expect to see the opportunity to transition to the private markets, and that's how we think about that.
And people often talk about how it's becoming an increasingly crowded space.
That's true.
And also people talk about how that could be systemic risks.
That's true.
How are you assessing that?
Yes. So when I think about crowds, I actually want to get away from them. So I'm looking for, and I think this is actually a critical question when you're evaluating the private space, you should look at people and say, what's the inefficiency you're monetizing? Because that's really what private credit is all about, right? If you're not monetizing inefficiency, you're in a commoditized market and you should not be able to generate excess return or alpha or value. And so what I look at is if the market is crowded, how many people are chasing after the same woman at the bar, right? That might be an interesting way, to think about it. And so
Haven't heard that analogy before.
Well, you know, I always have a few interesting ones to come out. But the way that I would think about it is I think what traditional private debt. So that is, to me, when I hear private debt, most people think of corporate direct lending. Again, that's not going to be my focus because I like to avoid the crowds a little bit, but there are a lot of people in that market. There are a lot of big players. What's even more interesting is that that market actually does, in many ways, compete with the syndicated markets, right? You can make a loan to a company through a direct method, like me to you directly. You can also make it in a broadly syndicated format. A bank can intermediate it. You can securitize that in a CLO. You can access it through a BDC listed. There are many different ways to get access to that same risk, but if the public markets can also do it and they can do it efficiently, then I don't know that it's going to be as inefficient as if the public markets are dislocated. So that's why I say it becomes kind of an interesting thing right now. You could actually see the market get a little less crowded to the extent the syndicated markets can't be as active, and that might be a better opportunity. But when you think about systemic risk, what I wonder is systemic risk a little bit harder to measure now because more of the risk is distributed in the private markets? You do see many new products, many new financial products. I mean, maybe people don't think of it's new, but when you shop on Amazon, do you not get the option to buy now, pay later? But that's a completely new financial product. How does that affect the leverage of an individual consumer? It's hard to measure when you don't have history. And our financial markets, we always want to go back to, where have I seen this before? What period of time is this similar to? And we can't necessarily make those comparisons as easily today. So I think we have to think in what I call, you can think about what should happen and use history, or you can think about what could happen. And I think we need to measure things by what could happen rather than what should happen in a market like today.
I want to take a look at alternative assets, and increasingly people are talking about a diversified portfolio.
That's right.
Where do alternatives fit into that diversified portfolio?
Yeah, so I think alternatives basically are offering you a tool that maybe you don't get in the traditional markets. Like we just talked a little bit about direct lending. You might call that illiquid corporate credit beta, right? I mean, that's really what direct lending is. So if people are overweight corporate credit, because there's a lot of ways to access that, and maybe it overlaps with their equity allocation, I think people are looking at how might I have more risks, not more risk. Right? And so the way that you might do that is think about, well, if I have a lot of exposure to corporate borrowers, how do I get exposure to the consumer in a way that's different than their desire to buy another t-shirt, right? And so that's one of the reasons why I think you see the alternatives market develop. Now, for some people, that's infrastructure debt lending, or that's real estate debt lending, or it's private equity. All of these things are considered alternatives. For us, it might be looking at things like catastrophe bonds or insurance-linked securities that have a completely different risk sensitivity, aren't sensitive to macroeconomic risk. That is the alternatives, and the role in the portfolio can be manifold. It can be diversification, it can be dampening of volatility, it can be alternative risk exposure. These are, I think, very valuable tools in a market where uncertainty is higher.
You know, Michelle, I'm just wondering, as more and more people gravitate towards alternative assets, is there really a real alternative asset? I mean,
that's a good question. It's the alternative. I mean, I think my impression of markets and in working with them as I talk to clients, there's like what I call main food groups, and then there's dessert or snacks. And I think that most people have, on the private credit side, if you think about it, have built out more of what I would call the main food groups. And so I do still view people as underweight some of these alternative buckets. And it is probably one of the more consistent asks at Schroders that we hear about. What can you tell me about how to get diversification in my portfolio? Now, this to me, the alternatives means like how many different ways can you look at a market, how many different ways can you access a product, and where are you actually getting a different risk factor? And I think that's the real point, is it's actually hard to get a different risk factor. So this is why I say there's a uniqueness about something that might have less correlation to the macroeconomy. And you might hear some people say the consumer is less correlated. But the consumer is pretty sensitive to the macroeconomy, let's be honest. It's just a different borrower base.
Right.
And so from an alternatives perspective, I think that market will continue to grow, but it may be considered less alternative as it becomes more familiar. Does that make sense?
Yep. And Michelle, it's been great having you with us.
Thank you. Thank you so much. I appreciate the opportunity.
Michelle Russell-Dowe, co-head of private debt and credit alternatives at Schroders Capital. Let's do a check on how futures are shaping up as we count down to the straight talks within the U.S. and China over the weekend in Switzerland. Futures up 0.1%. We're talking optimism there. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.